So we're going to continue from where we stop in volume 2. So this is going to be volume 3. And we've already marked out our expectation, the higher time frame bullish sponsorship zone, which we're looking forward to see that the market will trade into. So, in the last volume, I called our attention to the breakout block we have here, how we were expecting to see the possibility of price rising to mitigate this zone. And then we have the bearish continuation. But clearly here we can see price just gave the bearish fall to the downside, and we are in the Asia session. So we have the beginning of the London session here by 2 a.m. New York time zone, and here we have our New York session by 8:30 a.m. using the New York time zone. So clearly I do not really have a reason to want to consider taking a trade here. I would just have to look forward to what the London session would offer. If the London session offers bearish movement, then we should look forward to the possibility of the New York session giving us bullish. So clearly for you to anticipate that, then you need to look out for sponsorship zone by this particular side of the market, previous delivery. Look at the possibility of the market giving you that zone you might anticipate bullishness from. And what we can see is that this is the last up close candle that sponsored this bearish movement that took out this sell side liquidity. So we have the sweep of this sell side liquidity. So you can see how our zone is really a valid zone because it took out liquidity also. So clearly now it means if we're going to see the possibility of a buy movement, then we should look at this last up close candle before the bearish movement that took out this sell side liquidity. That is what we'll be looking forward to. So let's play price to see how price delivers to the downside. Okay, so you can see now we are in the London session, and the London session is giving us a buy reaction because price is reacting at this rejection block zone. So let's see how price moves. Okay, price is given a choppy market condition. So we can see the start of the New York session. So we'll be looking at the 8:30 a.m. New York time zone price delivery. So basically now we can see that this is the 8:30 a.m. So if we are expecting bullishness, then we want to see that price trade below the open price, and this is the open price. And clearly we can see that price have traded below the open price, now mitigating this sponsorship zone. That is the breakout block here in the 15-minute time frame. So once you've established your sponsorship zones, your point of interest, you've established the direction of the market from your higher time frame, you can just decide to just stick with the 15-minute time frame, to just be executing your entry and look for possible refinement in lower time frame, because you've already marked out the point of interest from the higher time frame. So you'll be leveraging on the perspective you've established from the higher time frame. You'll be leveraging that in the lower time frame to be executing your entry. So here in the 15-minute time frame, we can see now price have dipped into that sponsorship zone. So let's play price to see. We're looking forward to bullishness then in the New York session, because we can see that the Asia session gave us bearish movement. London further sponsored what? Bearish movement to the downside. So let's play price to see. So now clearly what we can see is we have the single candle order block. We can see how price swept this low, volume closed above, and we can see how this bullish candle now closed above the high of this candle that swept the sell side liquidity. So clearly now we have an expectation to work with, so you can execute your trade upon this candle closing above this high points. So let's check the 5-minute time frame. So here in the 5-minute time frame, we can clearly see this is the high points here that sponsored this bearish movement that took out this low. And what we can see there is that we have the change in state of delivery. Clearly we can see that we have the change in state of delivery here. Price sponsored the movement, mitigated the zone. We can also see we have the single candle order block here, sweep upward sell side, volume close above the candle that took out the sell side liquidity. So clearly this is your entry zone. So basically now you can take a long position from the high of this down close candle. The stop loss can be here, and then we target to see how price takes out buy side liquidity. We have this buy side liquidity. In extension, we have this other buy side liquidity. So let's project that to the upside. So we have this buy side liquidity. So clearly now this is going to be our profit target. So let's see how price trades to the upside. This is 1:3. So let's pay price to see. Okay, so we can see how price traded to the upside, because here we have clearly from the 15-minute time frame. Let's get there. You can see we have what? The single candle order block, sweep of sell side, volume close above this high. Now when we go to the 5-minute time frame, we can drop to the 1-minute time frame. So what we can see here is the change in state of delivery here. This is the down close candle that further sponsored bullishness. So we can take our entry there, the stop loss below this low point, and clearly we can see how price traded to the upside. So what you can see is that the Asia session gave us bearish, London session gave choppiness, but then sponsored bearishness. So definitely we should expect that one of the sessions should give us a bullish movement, and then we expected that to be in the New York session, and clearly the New York session now gave us the bullish movement to the upside, taking out this buy side liquidity, and that is already what? 1:3 RR. So clearly now what we can see now is we still have our sponsorship zone below that we're looking forward to see that the market will trade into. Let's go to the 1 hour time frame so that you can clearly see that. So here in the 1 hour time frame, what we can see is we can see the delivery in the 1 hour time frame is just a choppy delivery, then the push to the downside. So what we can see is that price here reacted within the daily fair value gap, the daily time frame bullish fair value gap. This was where price reacted at and gave the bullishness to the upside. We can see this is the daily candles, so we can see this is the daily fair value gap. Price returned into it, mitigated it, and gave bullishness to the upside. So what we can now see is we still have our zone which we identified from the daily, which is this mitigation block zone. And in confluence, we can see that we marked out an unmitigated wick from the 4-hour time frame. Let's get to the 4-hour time frame. So we can see that in the 4-hour time frame, we have what? This unmitigated wick, which within the 2-hour time frame, we identified that we have a bullish order block. This is the bullish order block here. You can see how it aligns to the daily mitigation block. And now price fell, gave us the bullishness that took out this. So this is our mitigation block. When we check the daily time frame, which we started this particular session looking at that from the higher time frame, the weekly, and going to the daily time frame. So let's get to the 4-hour time frame. So in the 4-hour time frame, we can see the likelihood of price dipping to this unmitigated candle wick, because it is also in confluence to the equilibrium and also the word discounts. So we can see price dip more lower. This is the equilibrium level where we have the mitigation block. So price may dip lower into what? Discounts, before we have what? The bullish continuation to the upside, because we are expecting what? Bullishness, just the way we've established from the higher time frame. So clearly now, let's just play price to see how price dips into the sponsorship zone we're looking at. So let's play price to see. Okay, so now we can see price dipped into that zone from the 4-hour time frame. Now we can see price have mitigated that. So clearly, once you understand what you're looking for, now we have bullish to the upside. Price created this sell side. So where's the sponsorship zone below the sell side liquidity? It is this. So you could possibly set an order at the mean threshold of this candle wick, your stop loss below here, and you target this high as the drawn liquidity. And in extension, we have the higher time frame high points as the draw on liquidity. So clearly now what we can see is price have dipped below the daily fair value gap, the daily bullish fair value gap, mitigating what? The mitigation block zone we identify from the daily time frame. Now in the 4-hour time frame, we can see this unmitigated wick. So let's check the 2-hour time frame. I told you guys I love to switch between time frames to have clear interpretation to this price delivery. So we can see it returned into this bullish order block. I told us that this movement was sponsored by a news event, so we can still consider this bullish order block as a valid order block. Now we can see how price returned to it, mitigated it. So clearly now from the 2-hour time frame, we can see that volume here closed above, but then price is reacting at this bearish order block. So to consider bullishness from this higher time frame, we want to see price trade above this, leading to a change in state of delivery. Then we expect the pullback to continue bullish to the upside. Let's check the 1-hour time frame. So here in the 1-hour time frame, what we can see is that we have the single candle order block, because we can see the sweep of the sell side, price volume closed above, and then we have this bullish candle that closed above this high. What we have here is a fair value gap. So let's do it with this so that we have a clear chart, since price have mitigated our zone. So we can see here we have this fair value gap. Let's mark that out. So we have this fair value gap here in the 1-hour time frame. So to continue bullish, we would want to see the likelihood of price returning into this fair value gap, and then we have bullish push to the upside from the 1-hour time frame. So let's check the 15-minute time frame. So here in the 15-minute time frame, clearly what we can now see is we are in the Asia session, and the Asia session has taken out these low points, taking out these liquidities. So we can see the Asia session took out this sell side liquidity, but then we still have the fair value gap below here. So we possibly might want to set a pending order at the fair value gap, and we have the stop loss below this down close candle. And clearly then we'll be looking forward to see how price pushes to the upside to take out what the buy side liquidity we have, the external buy side liquidity, which when we go to the 4-hour time frame, we'll clearly see that. So here in the 4-hour time frame, basically we know that, let's do it with this. So we know that this is the draw on liquidity, and in extension we have this draw on liquidity. So looking at what is happening now with price have mitigated the zone. So I told us if we're looking forward to bullishness here from the 4-hour time frame, our expectation would be to see how price closes above the zone, because there we have what we have, the up close candle that sponsored this bearishness. So if price closed above that, then we know that we have a change in state of delivery, and then we'll be looking forward to what bullishness. But from the lower time frame, you can see why entries need to be utilized from lower time frames. So you can see in the 1-hour time frame, here's where we're looking forward to see price takes out this high, because this is the last swing high that sponsored the bearishness. So if price takes this out after mitigating the sponsorship zone we identify from the higher time frame, then clearly what we have what is our market structure shift. First, we're going to have it as a change in state of delivery when volume close above the body of these candles. So we have a change in state of delivery when it closed above the high. Then we have what? A market structure shift.